Our guest suggests that with stock markets weak, a broad commodity exposure is a good hedge against inflationary impacts of this crisis. We're joined by Chhad Aul, Chief Investment Officer and Head of Multi-Asset Solutions at SLGI Asset Management. Chhad, thanks very much for joining us. Oil going up, $78 US in North American trading today, and that does point to inflation.
Yeah, certainly, and I mean this is another example with geopolitical risk, particularly in the Middle East. At the end of the day, it's primarily the concern for the market is that energy shock and the energy inflation. Really points to the fact that fixed income, for example, with rates being highly sensitive to that inflation story as well. The best hedge from a portfolio construction perspective is some broad commodity exposure. And even tactically, it's been very beneficial to our portfolios to be, again, overweight energy commodities coming into this event, and gold, which has been, it hasn't responded perhaps quite as much of a safe haven. We do think that it will, the longer this crisis may prolong, I think gold will become a pretty good hedge again. There was just, pretty frothy action in gold markets in the last, number of months now that there had to be a little bit of steam to come off. But I do think precious metals will ultimately be a good hedge as well.
Yeah, I guess the one thing is if the US dollar does strengthen because people go to it because it's a big liquid currency, that will tend to hold gold back.
Yeah, and we've had a theme as well, kind of the setup coming into here, at least the last, roughly 18 months now, almost, year and a half, where you have had US dollar strengthening, along with that, a rotation away from US equities to more international markets, Europe and Asia. And I think this setup here, so with those safe haven flows back towards the US, I think you're going to see some US dollar strength. Given also positioning was skewed towards being more underweight the US dollar. So I think you're going to see some movement back towards the US dollar. And then even on your equity positioning, we do think this is going to take a little bit of a rotation back towards US equities. Even though those inflationary impacts that we mentioned earlier on, ultimately Europe and Asia are far more exposed to disruptions to energy flow from the Middle East and particularly beyond oil, liquefied natural gas, significant price hikes that we've seen in the natural gas space really affecting Europe and Asia to a far greater degree. So I think, given that recent outperformance for international markets, I think you're going to see a little bit of a bid back towards US markets and the US dollar at the same time.
Yeah, Asia, I saw that the South Korean market has bounced back a bit, a gain of about 10%, but it's been in a frightening slide this week.
Certainly after some significant gains as well. And I mean, the construction of that market, obviously, significantly skewed to a couple of names, Samsung as well, for instance. So, a lot of what we saw this week and certainly earlier this week was also just kind of a deleveraging trade. This kind of, recent winners across assets took a lot of the brunt of the selling. So you could tell that there was some forced selling, some forced de-risking. So as the froth comes off some of those markets, you are going to see, I think, the underlying strength of certain characteristics. Precious metals, I think, is the one that got kind of caught up in that deleveraging that I do think old gold prices, for example, gold will be a better hedge for a more prolonged conflict. So again, gets back into having that more diversified exposure and commodities, energy, precious metals in particular, quite beneficial to staying diversified in your portfolio, making some tweaks to overall positioning certainly can make sense when it comes to geopolitical risk. But at the same time, significant deleveraging has typically not been the right thing to do. So significantly de-risking your portfolio, as geopolitics is typically the type of risk that markets, that kind of wall of worry that they tend to climb. That's generally where geopolitics lie.
Sorry, give us that point again. The markets.
So we always talk about, that, markets climb a wall of worry, right? So there's certain risks, and generally the geopolitical risks are ones that, cause some short-term concerns for markets, but they typically begin to climb that wall of worry as, worst case scenarios don't typically play out when it comes to geopolitics. So that's why it's rarely a good choice for investors to significantly de-risk their portfolios, but more do kind of a sanity check and make sure they've got some broad diversifiers, things like commodities in the portfolio that can help to weather the storm.
What about defense stocks? I mean, I know it's a cliche at this stage. People are going to be spending more on defense, unfortunately, wasting money on that instead of building schools, etc., and museums. In any case, without commenting on individual stocks, people are watching names like Stantec and Aecon. They are in line for a big radar win in Canada, for example.
Yeah, and this I would call them as the theme around defense stocks, and we certainly saw this in Europe-based defense stocks last year. This was already a theme that was playing out quite strongly. Some very strong outperformance in European defense stocks. That speaks more to the general theme going on around a world moving from kind of a single polar North American-driven consensus to one that's more multipolar in nature, where more and more countries are beginning to increase their defense budgets, beginning to take more responsibility, let's say, towards their own defense, their own infrastructure build. We see it here in Canada as well. So that's an ongoing theme. I think conflict certainly does raise, pull forward some of the pricing in terms of market reaction to that theme. But I do think that's an ongoing theme that's something that's likely to play out now over a period of years.
Yeah, and it's going to be tricky because we know that you're subject to the vagaries and whims of government when it comes to actual defense awards. Chhad, thank you very much indeed. Really appreciate it.
Great to be here. Thank you.
Chhad Aul, Chief Investment Officer and Head of Multi-Asset Solutions at SLGI Management.